When you first look at a financial chart, it just seems like a jumble of lines and colors, right? Total chaos. But what if I told you there's a hidden language in there? A structure that actually tells a pretty clear story. So, the big question is there really a system to all that madness? Well, if you ask a professional trader, the answer is a big yes. It's not about having a crystal ball to predict the future. It's about learning how to read the story the market is telling you right here, right now. And that's exactly what we're going to do. We're going to learn the market's basic alphabet, see how it builds sentences and structures, figure out how to anticipate the big plot twists, and then put it all together into a complete playbook. All right, every story has to start with the alphabet. And in the world of trading charts, that alphabet is built from one simple but super important component. Meet the candlestick. Each one of these is like a little snapshot of the battle between buyers and sellers over a set amount of time. And it packs in 4 key pieces of info: where the price opened, where it closed, the absolute highest point it reached, and the absolute lowest. It's pretty straightforward. If the candle is green, we call that bullish. It means the price closed higher than where it started. The buyers won that round. If it's red, or bearish, the price closed lower. The sellers were in charge. This simple color coding is literally the most basic language of the market. Okay, so if single candlesticks are our letters, what happens when we string them together? Well, we start forming sentences, and those sentences create the entire architecture of the market: trends. An uptrend has this really simple, kind of beautiful rhythm. First, the price pushes up and makes what we call a higher high. Then it takes a little breather and pulls back. But, and this is the most important part, it stops above the last low point, creating a higher low. The moment it pushes up again and breaks past that first high, boom, the uptrend is confirmed. It's just a repeating dance of steps. And understanding this structure is huge because it helps you see not just when a trend is happening, but also when it might be about to end. Listen to this. Professional trader Craig Percoco calls the moment a trend breaks and then gets retested one of his golden goose eggs. It's a key to finding some really great opportunities. We can even get a little clever and use the trend's own geometry to guess its limits. If you take 3 major turning points on the chart and connect them with a parallel channel, you create what's called an anticipatory channel. And this thing can project the area where the next big move might just run out of gas and turn around. It's surprisingly accurate. Okay, so now we can read the current story, the structure that's happening right now. Let's level up and get into forecasting. This is where we try to predict the market's next big plot twists. Is the story going to continue, or is a reversal coming? So there are 2 really important events you've got to watch for. The first is a break of structure, or BOS. That's when the price makes a new higher high, just like we talked about, confirming the trend is still going strong. But the other one, a change of character, or CHOCH, that's the first major red flag. It's when the market fails to make a new high and instead breaks a low. It's a huge hint that the trend's personality might be changing. Now, to get an even deeper sense of the plot, traders use something called Elliott wave theory. It's this idea that trends, because they're driven by human emotion, tend to unfold in a predictable 5-wave pattern. And the theory comes with a few very strict rules. These rules are great because they act like a filter, helping you figure out where you are in the overall story of the trend. All right, let's add a layer of math. And this is where it gets kind of cool. This number, 61.8%, also known as the golden ratio, pops up all over the place in nature, in shells and flowers, and, believe it or not, all over financial markets. It's a powerful point where prices often have a major reaction. So, how do we actually use this? Well, when you combine Elliott wave with these Fibonacci tools, you can make some amazingly precise forecasts. Here's how it works. You measure the length of that first big push-up, wave 1. Then you project multiples of that length, like 1.618 times, starting from the bottom of wave 2. And so often, the very peak of that final 5th wave will land right on one of those projected price levels. It's wild. So, a forecast is really just a theory, a good guess. A professional trader acts more like a detective. They're not just going to act on one clue. They're going to gather multiple pieces of evidence, what we call confluence, to build a really strong case. Let's look at a few tools in their toolkit. You've probably seen these before, classic chart patterns, things like double tops or bull flags. They're basically just visual shapes that show up over and over again.
Now, you wouldn't trade based on just one of these, but they provide excellent supporting evidence for a bigger idea. A more advanced clue is something called a fair value gap. This happens when the price moves so fast and so hard in one direction that it literally leaves an imbalance or a gap in the market. The pros know that when price eventually comes back to fill in that gap, especially the halfway point, it can trigger a really sharp, powerful reaction. And then we have indicators, like the RSI. It can help you see if the market is maybe overbought or oversold. But its real superpower is spotting something called divergence. This is when, say, the price on your chart makes a new high, but the indicator makes a lower high. It's a classic warning sign that the momentum is fading and the trend might be getting tired.
Okay, we've got all the pieces, the alphabet, the grammar, the forecasting tools, and the detective's kit for evidence. So now let's put it all together and assemble a complete, multi-layered analysis. This is the trader's playbook. You always start with the foundation. What's the main story? You just map out that overarching trend by spotting its basic structure, that simple pattern of higher highs and higher lows. Next, you overlay your Elliott wave count. This gives the trend a narrative, a plot. It helps you understand which chapter you're in. Are we in that explosive third wave, or are we maybe nearing the end, in the final fifth wave? With that story mapped out, you bring in the Fibonacci tools. This layer is what turns your story into a specific, measurable forecast. It gives you a calculated price target where that final wave is most likely to end. And finally, confirmation. This is where all the detective work pays off. You're searching for confluence, multiple completely independent signals all pointing to the exact same conclusion. So when your Elliott wave count says this is the top, and your Fibonacci target is in the same spot, and you see RSI divergence, well, now you've got a really high probability setup. So there you have it. We've gone from what looks like pure chaos to a structured, readable narrative. We went from single letters to a complete analytical playbook. The market's chaos really does have an order to it. So the only question left is, now that you have the tools to read the story, what opportunities are you going to find?